Unemployment is on the rise. Our first expert, Anna Wong, warns of significant challenges ahead.
Indeed. Rising unemployment insights could drastically impact your investments. And then we'll dig into Richard Koo's key analysis revealing the echoes of Japan's balance sheet recession in China. Get ready for essential strategies to guard your financial future. Our AI powers these summaries with expert insights distilled just for you.
Welcome to Financial Insights in Minutes. The goal is to provide you with vital economic news quickly and efficiently. We're powered by an advanced AI framework that transforms expert analyses into digestible content, saving you valuable time.
Each summary features insights from analysts like Anna Wong and Richard Koo, allowing you to stay proactive without digging through hours of video. Let's dive into Anna Wong's profound insights about the job market and potential risks lurking in the shadows of rising unemployment rates.
Time to navigate the currents of today's discussion. We're diving into compelling market insights.
Absolutely. In this week's recap, we dissect the latest shifts in the market post-correction with plenty of intriguing data to explore.
What's the overall thesis from Lance's insights?
The thesis is that after a significant correction, the market is showing signs of recovery. Strategic investments, particularly in sectors like AI and energy, are on the rise.
What does the performance of the S&P reveal?
It reveals a strong recovery trend in the market, counteracting corrections experienced just a week prior.
How does upcoming volatility factor into the market outlook?
With elections looming, volatility is anticipated to rise, creating both risks and potential opportunities for savvy investors.
What's the scoop on inflation data?
Despite optimism regarding inflation stabilization, rising costs are still impacting consumers' purchasing power.
What sectors are becoming focal points for investors?
Utilities and AI sectors are leading the charge, presenting fresh investment opportunities as demand grows.
And what about the investors' sentiments?
Investor sentiment remains pivotal. Maintaining optimism can lead to significant returns, even amidst volatility.
So, what are the predictions moving forward?
There's a high probability of continued market recovery as historical patterns unfold and investor sentiment shifts positively.
What's the outlook for corporate earnings?
Predictions suggest healthier corporate earnings as market conditions stabilize and growth sectors thrive.
What's the final takeaway from Lance's insights?
Stay alert for recovery signals while balancing risk management and strategic investments as market volatility rises.
And how should investors prepare for what's next?
Adaptability is key. Embracing changes and anticipating market shifts will position investors for success.
As we sail through the turbulent waters of today's job market analysis, our next insightful summary features Anna Wong, Chief U.S. Economist at Bloomberg Economics. She brings invaluable insights into rising unemployment and its implications.
Indeed. Today, Anna unpacks employment trends, pointing to signs that suggest the job market is not just slowing, but possibly tipping into a steep recession. Get ready for a deep dive into the intricacies of the labor stats.
What's the core message from Anna Wong's analysis?
The core thesis reveals a troubling trend. Unemployment is projected to climb to 5% and potentially stabilize there. This marks a significant shift, especially with recent hiring slowdowns across various sectors.
Let's dissect those key points, starting with unemployment rates. What did Anna reveal?
Anna points out that the recent payroll increase was only 142,000, lower than the average of 200,000. The unemployment rate edged down to 4.2%, but signs suggest this might not last amid a cooling job market.
Digging deeper, what are the underlying reasons for this job market wobble?
Anna discusses an intriguing duality. While immigration increases the labor force, it's also pushing the unemployment rate higher. Plus, temporary layoffs from events like Hurricane Barry are adding to the woes, sparking fears of more substantial job losses.
Now let's talk numbers. What do those economic indicators tell us?
It's a mixed bag. GDP growth has been adjusted up to 3%, which sounds good, but the stark revisions in job stats reveal inconsistencies, perhaps even overstatements in the actual hiring landscape.
What can we expect as we move forward? Any bold predictions from Anna?
Absolutely. She projects unemployment rising to 4.5% by year's end, and possibly stabilizing around 5% next year. It's a cautious outlook that tells us a lot about the labor market's trajectory.
And what about the looming recession?
Anna warns that if the Fed continues to delay rate cuts, it may deepen the recession. The sensitivity of the labor market to negative shocks is concerning, hinting at bigger problems down the road.
To wrap this up, what are the pivotal takeaways from Wong's insights?
It's imperative to scrutinize hiring patterns against the backdrop of looming economic pressures. As we stand on the brink, the future involves navigating carefully through these uncertainties.
Considering all we've learned, how do you think we should prepare for the challenges ahead?
We want to hear from you. Comment below on how you think we can tackle these employment issues. Your insights can steer the conversation forward.
Let's dive right in. Our next insightful summary focuses on Richard Koo's views on China facing a balance sheet recession. Is history repeating itself from Japan's past?
Here's the scoop. Richard Koo highlights that the real estate bubble in China resembles Japan's situation 30 years ago, indicating a potential economic downturn.
What's the key thesis from Richard Koo's analysis?
Koo warns that declining real estate prices are pushing Chinese citizens to pay off debts, signaling a troubling balance sheet recession. His insights reveal the deeper implications for government spending and monetary policy.
Let's break down the key points Koo discusses. What's happening with debt repayment?
As homeowners realize their properties are losing value, they focus on debt repayment. This mentality shifts from capitalizing on investments to simply surviving financially.
What are the broader economic implications here?
Koo highlights a drop in consumer spending, which can lead to an economic slowdown. He insists that government action is pivotal to mitigating this crisis.
What comparisons are drawn to Japan's past?
Koo's insights suggest that China's real estate downturn could lead to a prolonged balance sheet recession similar to Japan. This historical context serves as a cautionary tale.
What predictions does Koo make regarding government actions?
Koo foresees a necessity for substantial government intervention and reforms to regain economic stability. Without this, China may face prolonged economic stagnation.
So, what are the big takeaways from Koo's analysis?
In summary, China stands at a crucial crossroads. The effectiveness of government policies will determine whether they can navigate out of this balance sheet recession effectively.
What's the bottom line for businesses and investors here?
Investors need to brace for market fluctuations as Koo emphasizes the volatile nature of the current economic environment in China. Careful navigation is essential.
If you're finding value in these summaries, consider subscribing to stay updated.
Your support helps us continue to provide insightful content like this, so don't miss out.
Let's dive right in. In this summary, we're exploring how stable the stock market really is. After a recent tumultuous week, is the market finding solid ground?
Here's the full scoop. Chris Ciovacco takes us through the latest charts, unraveling the market's ups and downs. His significant expertise in economic analysis adds weight to his insights.
What's the core thesis of this week's video?
Chris emphasizes that the market shows signs of both instability and possible rebound. Recent trends suggest investors should be cautious, but there's also an opportunity on the horizon. Intriguing, right?
Let's break down those recent market fluctuations.
The S&P 500 saw its worst week this year, followed by the Nasdaq dropping 2%. But these dips often precede recovery periods, keeping investors on their toes.
What's the buzz about market recovery indicators?
Great news. A recent rally capped off the best week since the year began. With broad participation, it appears investor sentiment is shifting positively.
Now let's talk investment signals.
Chris points out the importance of moving between stocks and bonds. Staying nimble is key, especially when trends appear indecisive.
What does Chris predict for future market trends?
If the current trend continues, we might witness sustained recovery. However, inflation and consumer behavior shifts present constant risks to watch.
What about the Fed's role in market stability?
Absolutely. Upcoming rate cuts by the Fed could enhance market confidence. Historical data shows that these cuts often correlate with a positive market response.
What are the big takeaways from Chris's analysis?
The key takeaway is the importance of monitoring stability indicators. Adapting investment strategies as market conditions change is essential for long-term success.
And what potential shifts do we foresee from the Fed?
Key questions arise about how the Fed's actions might further influence market dynamics. We'll have to keep an eye on this crucial relationship.
As we navigate through the turbulent waters of today's economic landscape, the latest episode from Blockworks Macro dives into the imminent Fed cutting cycle and its potential implications for the markets.
Absolutely. Aluia, CEO of Lum Wealth, brings invaluable insights garnered over years of experience in investment management, perfect for decoding the currents of today's financial seas.
So what's the core thesis here? What's stirring the pot?
The core thesis suggests that with signs pointing towards a potential recession, the Fed may pivot towards rate cuts. This could create ripples affecting everything from commodities to stock valuations.
That's intriguing. Can we unpack the economic growth scare a bit more?
Certainly. The 10-year yield reflects heightened deflationary fears, while defensive sectors show resilience amid apprehensive market sentiment. It's a tug-of-war between growth and caution.
And how's the market reacting to this potential Fed move?
Speculation is rife. A looming decision could see either a moderate 25 or a sharper 50 basis point cut, with markets already adjusting in response, as evidenced by rising commodity prices.
What's happening on the consumer spending front?
While spending ticks upwards, rising defaults spell caution. It's a complex picture where optimism meets underlying financial strain.
Any predictions about where we might be headed?
Absolutely. Signs point towards a looming recession, especially if consumer spending falters and defaults increase. It's a warning bell in the economic landscape.
And what about future policy impacts?
Future Fed actions might ignite market rallies, but they could also fuel inflation concerns. Plus, geopolitical issues are wild cards that can disrupt economic recovery.
So what's the overall conclusion here?
Navigating these turbulent waters calls for strategic caution. As the Fed deliberates, investors need to stay well-informed and ready to adapt.
Today, we unpacked surprising insights from our experts about the dynamic economic landscape.
Absolutely. Anna Wong raised alarms about unemployment trends, warning of deeper issues.
And Richard Koo drew parallels with Japan's economic history, discussing China's precarious position.
Don't forget Chris Ciovacco, who highlighted stabilizing inflation but acknowledged its risks.
Aluia wrapped it up by casting doubt on how effective the Federal Reserve will be in maintaining stability.
These discussions have equipped us with impressive insights into the potential economic storm ahead.
If you found this valuable, like and subscribe to support our channel and stay updated.
Thanks for tuning in. We insist you check out our other videos to keep increasing your financial knowledge.